Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day. In this video, I'm going to walk you through the process of valuing Rolls-Royce Holdings stock by analyzing their financial statements and dissecting their financial ratios, so we can determine if it's a buy or a sell. Rolls-Royce Holdings is a British multinational aerospace and defense company. It designs, manufactures, and distributes power systems for aviation and other industries. It is the world's second largest maker of aircraft engines after General Electric. It also has major businesses in the marine propulsion and energy sectors. This company is the 16th largest defense contractor. We're going to look at the ticker that trades on the London Stock Exchange, so all the numbers in this video are in British pounds. But this ticker also trades on the pink sheets in the United States. The ticker is RYCEY. Let's get started with the model. This is a mid-cap company, 8.6 billion market cap. They're trading at a little over £1, and they have 8.3 billion shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So their free cash flow was growing quite a bit from 2017 to 2019, then took a big dip in the trailing 12 months, negative £1.5 billion. Net income is the profit and loss on the income statement. It's revenue minus expenses. They had a lot of net income in 2017, but negative in the other years. Revenue is the sales for the company, and that's going down. It did peak in 2019 at £16.6 billion, but dropped a lot in the trailing 12 months due to low travel and low demand. It's now £14.5 billion. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. And the difference between those two numbers is their gross profit. And their gross profit is decreasing each year. It was negative in the trailing 12 months for the first time. Then they have more expenses, operating expenses. So gross profit minus operating expenses gives you your operating income. And that was negative every year except in 2017. Below that is the interest they pay in their debt. That was $283 million. Below that is their pre-tax income. So they had negative net income every year except 2017. This is a statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. So even though they reported net income most years, they're still generating positive operating cash flow, except in the trailing 12 months. That was negative $265 million. Then you have capital expenditures, which are investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow. That's how much cash is left over to invest back into the business, to pay down debt, to pay a dividend, or to buy back stock. So they did have negative free cash flow in the trailing 12 months. I expect this number to improve in 2021 and 2022 as things get back to normal. Maybe not totally back to normal, but a lot closer to where it was in 2019. So the company issued similar amount of debt in 2017, 18, and 19 as it paid down. The company did issue a lot of debt in the trailing 12 months, £2.8 billion. They did pay down £600 million, but they needed this debt to run their business because they had negative free cash flow. Let's look at a capital structure. They have negative £3.3 billion of equity. That means their liabilities are £3.3 billion more than their assets. Their debt is £5.7 billion, so they're 100% debt, 0% equity. Their net debt is $1.2 billion, so they could pay more than £4 billion of their debt with the cash on their balance sheet. And their WACC is 10%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's £20 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of £14.7 billion. We divide that by 8.3 billion shares. And we get a calculated stock price of £1.76. They're trading at £1.03. So they're trading at a 41% discount. It's a buy according to the model. Simply Wall Street values the company at £2.2, so they're saying the stock is even more undervalued. I estimated in 2021 they would have negative $1 billion of free cash flow, then turn a positive in 2022. Then it would grow from there. These predictions are in line with analyst estimates. The stock was trading over £3 a year ago, and it touched close to £4, but it dropped below £1 a few months back, but it's a little over £1 right now. These numbers are in pence, 100 pence to a pound, so you can divide by 100. In 2020, the company cut its dividend, so it's not going to pay a dividend until further notice. The company's beta is 1.66, so the stock moves more than 1.5 times the market. The stock has gotten crushed the past 52 weeks, down 84%. The S&P 500 is up 17% in that same time frame. And the low was 1.6, the high was 7. And the stock is trading well below its 50-day and 200-day moving average. These numbers are in pence, so just divide by 100. This is a really liquid stock. 30 to 70 million shares are traded each day. And of the 8.4 billion shares outstanding, only 1.9 billion are on float, so it has a pretty low float percentage. 38% of the shares are held by institutions. If you invested $10,000 or 10,000 pounds into this company 10 years ago and reinvested the dividends, you'd have $1,800 today. If you did not reinvest the dividends, you'd have $3,900 today. So if you invested $10,000 into this company in January 2011, you could have doubled your money after a few years. But if you would have held on, you would have gotten killed because the stock price has gone down dramatically the past year. Causeway Capital Management is the biggest shareholder at 7%. That must be a British company. BlackRock at 5%, Harris Associates at 5%, then Capital Research, then MFS Investment. Let's look at the financial ratios. The average PE in the market's 11.3, the median is 14.5. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They have negative net income, so they have negative PE. Price to sales is stock price over sales per share. They're at 0.6, so investors are paying 60 cents for $1 revenue. That's a really good price sales ratio. Price to book is stock price over book value per share. They have negative book value, so they have negative price to book. And the way you calculate book value per share, it's equity over shares outstanding. Equity is assets minus liabilities on the balance sheet, and they have negative 3.4 billion pounds of equity. Their tangible equity is negative 8.8 billion because they have 5.4 billion of intangibles on their balance sheet, 1 billion of goodwill, and 4.4 billion of other intangibles. Interest coverage ratio is EBIT over interest expense. They have negative EBIT, so they have negative interest coverage ratio. ROE is net income over equity, negative net income, negative equity, so we can't look at this ratio. Current ratio is current assets over current liabilities. They're at 1.1, so they can cover their current liabilities with their current assets. And their current assets are 4.4 billion of cash and 4.3 billion of inventory. So there is a good chance the company will need more debt in 2021 unless it generates a lot more free cash flow than it did in 2020. The best way to look at ratios to compare them to similar companies, I've done videos of 16 companies in the same industry as Rolls-Royce, and if Rolls-Royce has a number in red, they're worse than the average. If they have a number in green, they're better than the average. They're worse in every category except price to sales. They have one of the best price to sales ratios of all these companies. But as you know, bringing in sales is one thing, but converting those sales to profit is another thing. So to summarize, I do have them trading at a 41% discount because their stock price has come down so much. I rank their free cash flow 3 out of 10 because they have a big negative. Revenue 5 out of 10. 14 billion is okay, but their revenue has decreased 11% in the past 4 years. I give their ratios 3 out of 10. They're pretty weak. Their products 7 out of 10. They seem to have really good products. And I give their brand 8 out of 10 because they are the second largest aircraft engine manufacturer, so they do have a good name within that industry. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.